GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Hey, Jim.
The Fed has decided, again, not to do anything, but it's making growly noises, as I say, about perhaps, maybe, they could hike rates in the future. Can you maybe explain what they said and why they might hike rates?
Well, yeah, they said the economy's coming back a little bit. You know, employment is picking up, and wages are up a bit, and consumer spending is up a bit, but a lot of those numbers are fictitious. You know, the employment numbers in the U.S. are basically, they're growing strongly, except that 90% of the new jobs being created are going to people 55 and older, and 90% of those jobs are in service industries that pay either the minimum wage or close to the minimum wage. So basically, you've got a lot of older people who should be looking at retirement, going back into the workforce and taking crappy jobs. You know, that's our economy right now. And that is really why the Fed hasn't raised interest rates. Normally, when the unemployment rate gets below 5%, historically we've seen the Fed raise interest rates pretty aggressively because that's the sign of an overheating economy when wage pressures would be pushing up inflation and causing instability, but that's not the case today because the labor market is very different than it has been in recoveries past. And so the Fed is being very cautious here. They don't want to raise interest, they want to raise interest rates, but they are reluctant to do it because first of all, the economy is not as strong as the headline numbers make it look. And second of all, the world is in turmoil. You know, if you raise interest rates, and you're the only country raising interest rates in the whole world, you run the risk of your currency spiking because everybody piles in to get higher yields, which then crushes your export industries, which slows your economy down and sends you into a recession. At a time when stock prices and bond prices are priced are trading at perfection levels and can't handle a downturn. So we're still running a lot of risks, in other words. And the Fed is cognizant of those risks and is reluctant to act. They're going to feel forced to act at some point because the big banks can't handle interest rates this low. Deutsche Bank, for instance, announced earnings today that was pretty bad, and they're still laying people off, and there seems to be no end in sight to it. And that's the kind of thing that is pretty typical for financial companies around the world. And so somehow something has to happen to save the big banks, or they just go into this death spiral where they end up laying off so many people that they shrink to shadows of their former selves, and their stocks plunge, blah, blah, blah. You know, the typical bad business environment situation. But in this case, it's for the big banks, which are the dominant entities in the global economy. So you can't have that happen. So anyhow, lots of cross currents. Central banks are basically painted into a corner they can't get out of. And every time they have to make a decision, it's some kind of act of desperation. You know, the Fed's this time around has been an act of caution because they're terrified of screwing up the global financial markets. But they can't go on like this, and they probably can't make any big changes. So there's really no help for them. There's really no help for the global economy. We're going to drift in this direction until something big happens to blow the whole thing up.
Well, this whole thing in Europe and Japan to negative interest rates, did they put any thought that it's going to blow up pension plans, banks, municipal bonds, things like that?
I'm sure they understand that on an intellectual level, but it's further out than the crisis that would hit if they tried to raise interest rates. So basically, they're just trying to delay the inevitable. Something bad is happening, and they're just trying to they're trying to choose the course that pushes the inevitable crisis as far away from their current tenure as possible. A lot of the guys in charge right now would love to retire before it all hits the fan. And so, seen that way, their policy choices make sense. I mean, seen as something they're doing for the benefit of our grandkids, their policies make no choice, or make no sense, because they're choosing things that actively hurt the prospects of our kids and our grandkids, but actively help their own retirement prospects. They're going to get through the next couple of years, they hope, and then retire with nice big pensions and go off into the sunset, and then their successors will be blamed for the crisis that hits. And so, seen that way, it makes sense, and they'll continue to do that for as long as possible, but it's not something you can do forever. Eventually, that kind of a strategy blows up on you, and so it's just a question of when, and exactly where the crisis hits. One of the things that's interesting now is that in Japan, there are stories coming out about how Japanese companies are seeing their stocks go up to the extent that they're willing to borrow huge amounts of money and use that money to take over other companies. In other words, we're creating a credit bubble because government bond yields are negative in Japan. So for companies to borrow money, they can borrow money very cheaply if they're a big company. And the stock market is rewarding companies like, for instance, Toyota for borrowing at 0.2% and then going out and spending that money in some way. And so now the 60% of Japanese corporations who are debt-free are seeing their stocks underperform because they're considered stodgy and overcautious, and they're being incented to borrow huge amounts of new money. So that's how the corruption of government finances is bleeding over into a corruption of corporate finances. And again, this is the kind of thing you can do for a little while, and then it blows up on you. We've seen that kind of a credit bubble happen over and over again, especially in the U.S. We did it with junk bonds in the 1980s, and then with dot-com stocks in the 1990s, and then with the housing bubble with, subprime mortgages in the 2000s. And now we're doing it with corporate debt. We've already done it with government debt in this cycle. So we're basically corrupting the entire fixed income market globally. And you can count on that having a huge, huge impact on our futures, and a really nasty impact.
Yes, well, I mean, we're watching stories on the TV news about 82-year-old women forced to live in their own cars because they can't afford rent. Their fixed income just is not keeping up to the cost of living. And by the way, what about the government's cost of living index? What a piece of bogus crap that is. Oh, we exclude housing and fuel because it's too volatile. Give me a break.
Yeah. The inflation numbers have come in for a lot of criticism, and I think a lot of it is justified because governments adjust their inflation calculations pretty frequently, and without exception, every single adjustment makes inflation look more favorable from the government's point of view. And that shouldn't be a surprise, When you reach the point of incompetence that most major governments have reached, corruption becomes inevitable. So basically you have the guys in charge calling the statisticians and saying, listen, we need you to meet this target, okay? And the statisticians find a way to do it. So the numbers coming out of major governments are bogus. And MarketWatch in the U.S. just published an analysis of corporate earnings and said that a growing number a large and growing number of U.S. corporations are publishing non-GAAP numbers and highlighting them. In other words, not according to generally accepted accounting standards. They're kind of making up their own numbers, and they're highlighting those numbers as the more legitimate way of measuring how well they're doing. And surprise, surprise, those numbers are much, much better than the numbers that they get when they apply GAAP accounting standards to their operations. So we're seeing, lying almost across the board in terms of official statistics. I mean, nobody believes China's numbers anymore. And there's a reason for that. They just make up their numbers. And lots of people don't believe corporate earnings releases anymore because of studies like MarketWatch's. And the same thing is true of U.S. and Japanese and European government economic stats. A lot of them are massaged or completely fabricated. And so when you reach a point where nobody trusts anyone, you're at the end of the road. That you've got the crack-up boom coming, or some kind of currency crisis, or debt-driven implosion. Some kind of a crisis is heading our way, because people no longer trust these big systems. They're willing to vote for outsiders in every single election. Donald Trump is actually winning right now in public opinion polls in the U.S. And Brexit, of course, is an example of that. And Marine Le Pen in France. The outsiders who are willing to call out the inconsistencies and the corruption of the current system are generating more and more votes, because people are coming to believe that that's the truth of the matter, that the systems aren't working for regular people anymore. And so, it becomes impossible to disconnect or to separate the economy from government, from personal finances at a certain point. It all becomes one piece, and the process of people pulling money out of the financial sector will start to gain momentum here pretty soon. And money will flow into real assets, which is to say gold, silver, farmland, energy assets, things like that, and out of financial assets. And at that point, and we've seen this happen over and over again, junk bonds blew up in 1990, and money flew out of the financial sector. Tech stocks blew up in 2000, and money poured out of financials, and same thing over and over again. Only we're creating a global version of that, and so it isn't exactly clear where everything goes, because the real asset side of the global economy isn't nearly big enough to accommodate all the financial wealth, quote unquote wealth, that will flow out when the time comes. So we'll either see an incredible disruption, some kind of discontinuity in the global financial markets, or we'll see a really amazing price spike in a lot of these real assets. So I think the people calling for $100 silver and $5,000 gold are probably being conservative at this point, as crazy as things are getting. When corporate bonds start having negative yields, then you have very few places to put your money that will generate any kind of positive cash flow. So in that case, why bother with financial assets when gold generates zero cash flow, which is better than the negative cash flow that you get from government bonds and now corporate bonds. So you're going to see more and more money flowing in the direction of that calculus. In other words, out of really badly yielding financial assets and into stable, at least, real assets. So that's our future. It might happen really chaotically, or it might happen fairly smoothly. There's no way to know.
We'll have more with John Rubino right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with John Rubino. John, the BC government has just imposed a 15% tax on real estate purchased by foreign buyers. The idea, of course, to try to slow down the Vancouver real estate market, where the price of a home has been going up about 30% a year, and a shack on the east side of Vancouver goes for $1.4 million. Is a tax like that likely to work?
Well, when huge amounts of hot money flow into a relatively small country like Canada in terms of population, it creates huge problems. And so governments traditionally try to do something to slow down the hot money inflows because, it spikes prices for everybody. So the locals find themselves being priced out of whatever asset class the hot money is flowing into. And those are the voters. So if you're the government, you don't want your voters to be mad at you because of all the Chinese money coming in and making their lives miserable. So you try to do something about it. But historically, if you look around the world at the times hot money flows have destabilized countries, there hasn't been a really successful strategy implemented for slowing down that inflow in a way that isn't disruptive in its own right. And I think taxing the asset classes that foreign money is pouring into is not a bad idea intuitively, so maybe it'll have an effect. But you never know with things like this, because when you start intervening in markets, you get lots of unexpected, unintended consequences, and it's hard to know ahead of time what they're going to be and how bad they're going to be. So I don't know. I totally see Canada's point, though. You guys should want to slow down the inflow of hot money, at least as it is affecting Vancouver real estate right now, because you guys have a crazy real estate bubble there. And there's never been a time in human history when this kind of a bubble occurred without a corresponding crash to bring things back into a reasonable balance. And you don't want to go through that crash. So if you're just taxing foreign real estate purchases and money keeps flowing in, but it flows into other sectors, maybe that's not bad. Maybe it can go on for a while without causing you too much disruption, but I don't know. It's really, really unusual for a country to be able to manage hot money inflows without some kind of disruption.
Well, this law in British Columbia applies only to Greater Vancouver, so to about 2.34 million people, maybe close to 3 million if you start getting outlying areas. But prices were already starting to come down. Did the government really need to apply a hammer?
Yeah, I have no idea. Because the idea that hot money flows out of China and Russia and in Europe for that matter, the idea that that's going to stop anytime soon is probably over-optimistic, because those guys have big problems that they aren't fixing in any meaningful way. And so there's going to continue to be terrified money flowing out of those areas and looking for a home. So, maybe Vancouver real estate has reached the point where it just can't go up anymore no matter what. But the question is, where does that hot money go afterwards? And it could be that it flows to other real estate. If you can't reasonably buy in Vancouver anymore, then you start looking around. What's 100 miles from Vancouver? Is that attractive? If
Absolutely.
You're a Chinese expat?
Sure.
And so maybe that's where the money goes. And so maybe you get a kind of an equalization where Vancouver stabilizes or drops a bit, and some of the surrounding areas really start to get bubbly. And I don't know whether that's a fix of any kind, but it could be that that's what happens, and then they have to put on some other kind of capital control to stop that process from becoming unstable? I don't know. This isn't an easy question to answer because we've tried many, many times in the past around the world to deal with stuff like this, and nobody's really come up with a good solution.
Well, if you have enough money to go and pay $5 million for a shack, what's $5.5 million?
Well, yeah, that's the thing. Is 15% enough to stop this terrified money from buying this particular set of assets?
The government says the law could be pushed up to 20%. But as you say, it's just applied to the greater Vancouver area, and places like Victoria and the rest of BC have all seen real estate prices go up because, as you know, it's just like water. You can't stop it. So if prices start to rise in Vancouver, they bring the prices up everywhere.
Eventually they do. You see that in real estate bubbles in a lot of U.S. cities. San Francisco real estate gets hot, and then the prices of 20 miles out, and then 30 miles out, and then 50 miles out. The people who commute in find themselves paying huge amounts more for real estate out there. So, it's the nature of a credit bubble for this stuff to happen. We're creating way, way, way too much currency around the world, and that currency has to go somewhere. So it goes en masse in the hottest direction normally, and that causes instability, and then it causes a crash, and then that terrified capital goes somewhere else. And so it's been doing that for 30 years now, just kind of flowing around the world and causing chaos wherever it goes. And there's really no end in sight because we're ramping up the process of currency creation. Interest rates are getting more and more negative. Governments are talking about bigger and bigger stimulus programs, and so all we're going to see going forward is more of what we've seen in the last few years until it blows up. And that's what you can't know. You can't know when the party ends, when the music stops. But you know that it's going to. And that when it does, the numbers are so huge that the consequences will be gargantuan.
The Canadian government plans to run up $30 billion deficits for the next few years to stimulate the economy. Now, that $30 billion, if you went and gave that money to Canadians individually, it's about $833 for every man, woman, and child in the country. Would the money be better off being sent directly to the population, or is it better in government hands and spent on bridges?
Well, that's the debate now, because it didn't really work to just give it to the big banks, which is what we did via our QE programs around the world. So they're going to try something else, some variation of the debt jubilee, where you just give money directly to people, and then you do it with a proviso that they have to pay off debt or not, whatever. You just hand people money, and the assumption is that one way or another, that money gets right into the economy. If they pay off debt, then the creditors that they're paying off have more money to lend. If they just spend it directly, then it just goes right to whoever they're buying stuff from. And so the hope is that you get a really big, quick Keynesian stimulus from something like that. Of course, it really doesn't matter in the end. If you monetize your debt, if you create a whole bunch of new currency and dump it into the market one way or another, you get instability. And so what we're creating the conditions for is a gigantic currency crisis somewhere out there in the future. And amazingly, it really keeps surprising analysts who are looking at the numbers and just saying this is historically unprecedented, it can't keep going on. It's amazing that it can keep going on, that they can keep finding new things to do that keep the party going. And so this looks like another one. It looks like they probably can indeed get a Keynesian pop by just giving money directly to consumers and assuming consumers are going to spend it, and that it will increase growth. But of course it will also increase instability because the amount of debt that we're taking on in order to do this, one way or another, and even printing currency is taking on debt because a piece of currency is an IOU. It's going to be converted into real stuff at some point. And so you create artificial demand by doing that over and above the real stuff that exists in the world, and that pushes up the prices of real stuff. So if we do the debt jubilee, that'll be hugely inflationary and cause instability that'll be hard to handle. So really, whatever we do, we've got a crisis out there because we're past the point of no return for all the debt that we've taken on, and that debt has to be gotten rid of somehow. You can't do that painlessly.
John, thank you so much for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. If you have any questions for John, you can email us at info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.